topic is in front of everyone here. It's understanding the startup funding strategy from the investor's lens. I'm going to spend some time on what exactly my company Chatur Ideas does, what I've been doing in the company for such a long time, what has been my investment thesis, maybe sharing a couple of case studies, and also some of my investments and how they're faring right now. So that's how I'm going to plan out today's session. If there are any questions, please feel free to ask. So beginning, what exactly we do? So we basically do four things. One is we raise funds. The second is we mentor businesses to scale up. Third is we have a training programs which we run across India. So we have trainers who go and conduct these programs where they lay a foundation about how one needs to go about implementing the startup. Having said that, startup is not something that it can be pushed upon to anyone, or entrepreneurship can be pushed upon to someone, but still a guideline can be created, which if an entrepreneur or a startup understands or abides by, the chances of success increases dramatically. The fourth is support services in terms of if somebody needs help on their pitch deck, on their valuations, on the technology, on the go-to-market, etc. We have an entire team which helps them to do that. What have we done so far? We have worked with over 1,100 startups. We have close to 1,500 investors from India and US put together. We have over 200 plus mentors, and these mentors are at the CXO levels, right from a Google to a Deloitte to a BNP Paribas to a KPMG to a Facebook. So the best of the best companies across the globe, the CXOs there are a part of our team who help our entrepreneurs to scale up with their domain expertise and their network. So far, 58,000 entrepreneurs have benefited through us. We have acquired a company called as Nurture Talent Academy, which was the first institute for entrepreneurship in India. We acquired this, I think, 4.5 years ago. We have won multiple awards nationally and internationally. That's my profile. Steelers did a lot of justice in introducing myself, so I'll not spend much time here. Of course, a few awards that I have received is the CEO of the Year, which was in the year 2019, which was received in Dubai by the GISR Foundation and American College of Dubai. I've also received the Mahatma Gandhi Samman Award, which is given to only 25 Indians all over the world. This was presented by Meera Kumar, who was the former speaker of Lok Sabha in our country. I was also awarded the Youth Leadership Award by the Trade Commission of Canada. I've also been awarded by the Entrepreneur of the Year 2018. So there are quite a few, but let's not spend much time on my profile here. And let's come to the topic. So what's my investment thesis? So when an entrepreneur or when a startup comes to me, what do I actually look at? Or forget me, what any investor looks at when a startup comes to the table. So most of the things that I do, I can also resonate that with multiple other investors in the community, because we all have a similar kind of a thinking, similar kind of thought process when we evaluate startups or when we end up investing into them. So there are two things that I look at. One is the PDF, and as mentioned, it's not the Adobe PDF. What it is, I'll come to it a bit later. The second is a business plan. So when we say a business plan, what exactly I look at? So of course, I need to see what is the P&L of the entrepreneur's startup. What's the 5-year horizon? What's the kind of revenue he's going to make? What's the kind of expenses he's going to do? What's the capex, opex? What is the way he's going to scale this up? How's the balance sheet going to look at? So of course, all of these things are very important. But out of these, the four things that I really lay a lot of emphasis is on these four. To begin with, the scalability. So any business that I wish to invest in, I want to see that business has to be highly scalable. Because if you're investing into a business and that is not scalable, the economies of scale don't set in, your investment does not grow, the entrepreneur does not benefit, the investor does not benefit. So scalability is of prime importance. So it has to be a scalable business, has to have a good market size, and it And definitely, if the market size is good, it is scalable. Another thing that I focus on and I lay a lot of emphasis is on the unfair advantage. So what I mean by unfair advantage, so it is the advantage that the entrepreneur has over its competitors, which can't be bought by money easily. So for instance, it can be the network, it can be the loyal customers, it can be technology, it can be patents, it can be a copyright, it can be anything in the IPR segment. So some of these things which differentiates the business from the competitor. So for me, the unfair advantage plays a vital role. Why should I put my money in your business? What are you doing so differently that the others aren't, and they won't be able to copy you easily? So that's the second. The third is the revenue model. So for me, the revenue model plays a lot of emphasis because just spending money and building a brand may not always be the right way of doing business. Many a time, what is really important is to have a strong revenue model which can absolutely help you to scale up your business. Of course, many a time when we are scaling up businesses, the revenues may be small, but eventually they try to scale up. But revenue is very, very important. So having a strong revenue model is equally important as the other three parameters when we or I am evaluating a startup. The fourth is the go-to-market strategy. So what's your go-to-market strategy? So what are you doing so differently that the others aren't doing? So do you have a go-to-market strategy which is low on cost but high on efficiency? And is it something that others aren't able to do because you have an unfair advantage and hence your go-to-market strategy works well, which culminates into a better revenue model and hence a scalability? So this is how all the four are integrated, and hence a lot of emphasis is laid on the four of them because the four of them together become a huge equation which helps the business to scale up. The business plan that I talked about right now, I lay my 30% emphasis there. My 74% emphasis is on the team. My major focus is on the team. Why so? Because in the past experience of investing into startups and dealing with so many startups, mentoring so many startups, guiding them, scaling them, I've realized that the execution team, which is the entrepreneur and his core team, is the one who can make it or break it. Many a time, when I even come across businesses which seem to be a beautiful business, $1 billion business, but I don't see the execution capability by the founders, I shy away from investing there. On the contrary, if I see a business which is an okayish business, may not turn out to be $1 billion business, but I see the driving team, the core team who's driving the business, very passionate, with the right set of domain expertise, with the right set of execution capabilities, my money is with them. Because for me, the team plays a major, major role here. I bet on the jockey and not on the horse. If the execution is good, everything falls in place. If the execution is bad, even the best of the best ideas can fail. And I've seen that in multiple cases, and hence the team. So, so when I'm evaluating a startup or when I'm evaluating a company to invest into, I look for two things. So one is the PDF, which the acronym stands here for perseverance, discipline, and focus. So for me, these three parameters are of prime importance in any entrepreneur that I'm betting my money on or putting my money on. And let me spend a minute to explain each one of these. So when I say perseverance, let's take example of Colonel Sanders, who started KFC. He had 1009 failed attempts before KFC came into what it is. We all have heard of Thomas Edison. He had 10,000 failed experiments before the electricity that we have today. Hence, being perseverant is very important. What we see in most of the cases is entrepreneurs try for 5, 10, 20, 25 times, and then they're like, it's not happening. They just don't push themselves harder to see that what's that point where they just cross that line and they see success coming in. So for me, perseverance plays a very important role. Having said that, it does not happen that I meet an entrepreneur and I know he's perseverant. Of course, I spent close to say 30 to 45 days with a promising team to ensure that they have these characteristics in them. And there are different ways I judge them. There are different ways I analyze how good, bad, or ugly is this proposition turning out to be. And then the investment happens. The second point is discipline. Uh, Again, let me take an example here. Many a time we all have seen that, when startups get funded, they behave like a college student who got his first job and he just wants to blow up his entire 1 month's salary that he has achieved at the end of the month or received at the end of the month. That's what we see in a lot of entrepreneurs. The moment they get the first round of funding, they're all out to spend that money and just enjoy that money. And the entire discipline with which they had built the business from A to Z, and because of which the investor that invested money into the business goes for a toss, because now the entrepreneur is no longer frugal. He just wants to blow his money. He just wants to enjoy the money that he's received. The entire discipline goes for a toss. So being disciplined is equally important as being perseverant and focus is. And the third one is focus. For me, it's very important that the entrepreneur needs to have a laser sharp focus. And why is that? Because I'm sure whoever's listening to us today, if they have been through the entrepreneurial journey, they would have realized that through their journey, they have a goal that they are walking towards or running towards. And every time they have some of the other opportunities keep coming their way, which are exciting, but not as big as a goal. But they feel that why not we grab this opportunity as well, this as well. What happens in the bargain is that, of course, you might reach a goal which is in front of you, but your pace slows down. So the goal that you're able to achieve, say, in a span of 3 years, it goes to 5 years because you were trying to grab every opportunity which you were aware wasn't as big as the goal that you have. Why I'm emphasizing on the word that it wasn't as big, because many a time when you're walking a path and you come across an opportunity as big as a goal, it makes sense to grab that opportunity. But if you know that opportunity is not as big as a goal, but it's easy money coming in or easy clientele coming in, and you just want to grab it, that's not the right way of doing business. You need to have laser sharp focus on your goal and just work towards that. And small little things that keep coming away, one can ignore that because walk towards your bigger goal. So the PDF that I focus on is being perseverant, disciplined, and focused. The next thing that I also look at is the empathy study. I would want the entrepreneurs to conduct a survey about the service or the product that they're working on and take a first-hand feedback from their customers. Let me take an example. So for example, the entrepreneur is building a product, and for the product, he needs X amount of money. For me, the first steps that would be involved here is I would want him to maybe create a demo of the product, reach out to his prospective customers, and that size has to be a decent enough size, a big sample size, and go and talk to them and ask them, this is the product that I'm building. These are the features of my product. What would you like to say about it? Would you want to take it, not take it? I'm sure the entrepreneur gets a lot of feedback in terms of what features can be included more to make it a better experience, what can be reduced to make the product less cluttered, and what all can be done to enhance the user experience. I would then suggest the entrepreneur to take that feedback, come home, design it, make it better, again, reach out to the customer and take a feedback. And once he's sure that he has created something great, then goes the step number 2, where he goes and does the crowdsourcing of the price of the product, where he reaches out to the customer and asks, okay, I've made the product as per your specifications, or taking the average of everyone's specifications and created this product. Now, what's the price that you're willing to pay, and understand from them? And as long as that price is above your cost price and you're able to make a decent margin, one should agree to that price and sell it out in the market. Because many a time what happens is entrepreneurs feel that if a bigger brand can sell it at, say, a 300% margin, why should he be selling at a 30% margin? But what the entrepreneur does not understand is that the person who's selling at a 300% margin has spent in so many years to build that brand, has a strong after sales team, ensures that kind of a brand presence and a premium quality to his product, due to which that brand can command a 300% premium. But for a newbie, even a 30% margin on the cost is good enough to enter the market and start capturing it. So second point is crowdsourcing the price. Now the third point is quite a difficult one to implement, but if one implements it, the chance of success increases dramatically. And what that is you actually go to your customers and you ask them for a 10% advance of the product that you're about to sell them. Now, what exactly happens when you ask someone for a 10% advance of a product which you've not handed over to them, and you might be able to give it to them after a month's time? There are three benefits of it. The number one is that the customer would give you genuine feedback. The customer would just not say it's a good product just so that you just rush away, because the customer also understands that if he or she says the product is not good, you're going to spend another 20 minutes with the customer to understand why the product is not good and what all he or you can change so that he or she takes the product. The customer does not want to waste that much of time, and he or she says, okay, it's a good product, so I'll buy it once you get in the market, and he shoos you away. But if you ask for a 10% advance, what happens here is the customer has to give you a genuine reply because he's putting 10% on the table. The second point is related to the first one, which is human psychology. The pain of losing 10% is much higher than the pleasure of gaining 90%. Now, let me let me tell you that with the help of an example. Let's assume we're using a wallet, and in a wallet we just have $1 left. Now, and let's assume that somebody says that the wallet that you're using right now is going to expire tonight, and if you don't spend the money in your wallet, this money will go down the drain. Now, $1 isn't a huge money, right? But still people would be like, why do we waste at $1? Why not just order something online and just use $1, right? The thought comes in, because why do you waste it if you have put that money into your wallet? At the same time, so that $1 is actually a 10% of a $10, right? So now the remaining 90%, which is say a $9 bill you see on the road, right? You see a $9 fallen down the road. What would be your instant temptation? Would it be to put it in your pocket or give it to a needy? What I understand is that people would actually give it to a needy, because why to just pick up a $9 from the road, just walking down, and it does not belong to you? And why should you just pick it up with somebody else's? If you can't return to the person, might as well you find a needy on the road, just give it to that person, right? Now, why is this happening? Human psychology, right? You have a pain of losing your own 10%, but you're not excited of finding just another 90%, and you're happy to give that to somebody needy, right? Because of this psychology, you would get the right feedback from your customer who's actually paying you the 10% advance. And that customer is just not paying you advance to shoo you away, because the customer's paid you 10% advance. When you go with the product to the customer after a month's time, that customer is going to pay you the remaining 90%, because he's already invested the first 10%, and now he wants the product and he's happy to pay you the 90%. That's how human psychology works. The point number 3, and one of the most important point, is an entrepreneur entrepreneur needs to have 2 things with him. One is he needs to be very strong on integrity, and the second is he needs to be an excellent salesperson. He should be able to sell an ice to an Eskimo or a comb to a bald person. By doing this exercise, you are actually showing your sales capability or ability by actually selling a product to your customer, just not out in the market, even taking a 10% advance. So that shows you how good are you in sales, and that will actually set your benchmarks of success. So for me, these things play a lot of important role, and hence for me, the team plays a major part. where I understand the team's personality through the PDF route, which is personal discipline and focus, and I understand their efforts that they've put in to do the empathy study to be sure that they're walking the right path. I'll share a couple of case studies and then talk about my current investments and their status so that you all understand what I do and how I do. So first I'll talk about this AI-based chatbot that we help. So, these guys actually Googled us and figured out, and they wanted an appointment with me to discuss their idea. I think I was able to give them an appointment after say 30 or 35 days because I was running a busy schedule. And when I met them, they said that they want to build an AI-based chatbot. And I told them, there are multiple people doing that. You don't have a very novel idea. I don't think it's going to make a difference. So that's from my side. So I don't think I'll be able to help you much. They said, can we get a meeting with you? So this was over a phone call. So I said, it's going to not be worth your or my time because I don't think this can kick off. They said they still requested for a meeting. I said, fair enough. They came to my office and we had a chat. At that point of time, they said that, what we have heard a lot about how Chatur Ideas is helping companies scale up, how you have invested in mentored companies. They're like, we are pretty confident about our business model of this AI-based chatbot. We would just want you to be on our board and help us scale this up. To which I discussed with them and I told them that the chances of success here is hardly 2%. They agreed. They said, we are okay with even that chance, but we want you on our board. We are happy to discuss the commercials, whatever your fees are, whatever equity you wish to have in our company, all of those things, we are happy to sign up with you, but you just come on our board. So to which I thought over and I agreed, and we signed up an agreement to which we said, okay, we'll guide you, but what I need from your end is so and so thing. So I ensured that I wanted the founders to spend their time, made a roadmap for them, wanted them to execute that roadmap, and it was an entire plan that was given and was expected to follow to the T, so that the 2% of success actually turns into 100%. What happened here was, even I was surprised, these entrepreneurs actually put in their 100% and they did everything to the T. And eventually, this AI-based chatbot became so better than the existing players in the market that these guys actually got an offer from Google Automation to acquire them, to which they said no, because they said, we want to move much higher and we don't want to stop here by getting acquired by a company. And in a span of 3 years, these guys have got 2 offices in India, have a team strength of 40 plus people, have raised a funding of $2 million, have made a product which is being used by so many corporates already, and they have scaled up pretty fast and being better than the competitors. Here, what actually happened was, the entrepreneur's dedication and focus on building the business and following everything to the T. Number 2, of course, our team spending that time with them and guiding them. And number 3, they picked up a business which was scalable and worked in the right direction. So sometimes having the right set of mentors, investors, and the guiding force with the right set of team works as a beautiful combination for things to scale up. Likewise, there was another company in the logistics business who reached out to us and they said that, what we are doing business and our turnover is around, so I'll talk in dollar terms. So their turnover was say around $300K. So 300,000K. So that $300,000 was their turnover, yearly turnover. So they reached out to us and they said, we are doing this kind of a turnover. Would you help us to make things a bit better? So here we did a bit of brainstorming. We thought to create an unfair advantage for them, which the other players aren't doing. So most of this logistics company, what they were doing is they were taking the consignment, they were taking the fees from the customers and then shipping it. What we did with them was we built an unfair advantage of saying that, whatever the consignment value is, you're going to offer that much amount of benefits to your customers in terms of vouchers, which they can encash for whatever they need. So for instance, we did a study about the customers and what these customers actually do. So most of these customers were into remitting foreign currencies and into traveling a lot. So we made them tie up with a couple of companies in the same domain and gave them vouchers worth the same amount of the consignment to these customers. So now what the customers thought was a double benefit. A, they're paying an X amount and they're getting the work done. Plus they're getting an equivalent of an X amount of vouchers, which they can actually use for their needs, which is travel and remitting foreign currency. Now, that created a lot of virality because these customers went and told the entire world, this is what this logistics company is doing. Why don't even you start working out with them? And some of these customers who used to give just 20% of the business to the logistics company ended up giving 100% of the business. So what happened? It became viral. The logistics company started making more money. Third point, these couple of brands that we tied up with them, even they paid money to the logistics company because they were helping them promote their product as well, right? So when they're giving these vouchers, the customer does not stop there. He spends more using those vouchers, right? So the brands also make money for which they were giving a fixed amount to the logistics company. Because of these three benefits, the turnover in a span of 1 year quadrupled. And from 300K, it actually crossed more than $1 million of turnover on a yearly basis. So that's what happened here to, help this company to scale up their business. So the first two examples that I just shared right now is more about how, as an investor, one can add value to the company apart from just giving money. Because many a time you would want these companies to also grow, because if these companies are growing, your money also grows. So as an investor, you need to also be a strategic or a smart investor where you also leverage your intelligence, domain, and network for the companies to grow. The next point that I want to talk about is what have been my current investments and what has been their status. So as an investor, one needs to be mentally prepared that if you're investing into 20 companies, 18 of them are actually shut down. And just 2 of them would give you like 100x kind of returns. And that takes care of all your 20 investments. So that's the mindset with which you have to invest into startups. But when you're investing, every investment should feel that this is your best bet. And this is the bet that is going to actually make you huge money. Having said that, mentally be prepared for just 2 of them panning out to be winners. So basically what I'm trying to say here is you hope for the best, but be prepared for the worst. So let me share a few examples where I've invested and why I invested and what's the status. So there's this company called Hubilo. It's an event tech company. I invested in this company in 2016. I invested because I loved the founder. I liked the way he was executing his business, the way he had the thought process, the way he was growing his business, the way he was managing the team. So I had invested in that company in the year 2016. 2020 November, I got an exit of 8x on my invested capital because he raised around $4.5 million. From India, he has moved to San Francisco. His headquarters have moved. In 2021 of February of this year, if I would have waited, I had not exited in November 2020, he raised another $23.5 million. So my 8x could have been a 24x, but that's what investments are all about. Sometimes you exit too early, or sometimes you wait too long and you actually lose out what you're actually getting in. So here I cashed out early with an 8x exit. So that's the status of one company that I invested in. Another company that I invested was based in Singapore. I invested because I liked the product. I couldn't spend much time with the founders, but I thought they were promising enough. But it happened a couple of years ago that they sent me an email saying that, you know what, we are shutting down because we couldn't take the business to the level you wanted. Where I missed out was I couldn't be very vigilant in terms of keeping a track of the progress. In fact, that day also, when they sent me the email, I just wrote an email saying that, do you wish to get on a call and discuss? They didn't revert, even I forgot about it because I just invested some amount of money, which wasn't a huge amount of money, seeing the investments that I end up making, or even if I keep the 20 benchmark. So it's like 1/20th of the investment that I made has gone down the drain. So this company got bust. So whatever invested got to zero. Third company, which was into the business of cloud servers, has now moved into crypto, but has changed two businesses already. So this business, I exited on principle. So whatever I invested, I took that money out because this entrepreneur was changing a lot of businesses where I wasn't much comfortable to see which direction this business is going now. So I exited. So yeah, of course, there are multiple other investments that I've done, but if I keep sharing, that will take another 1 hour, and I don't think we should spend that much of time. But yes, so that's what my thesis has been. Somewhere I like the founder, somewhere I like the business, and I end up investing into them. Sometimes I get an 8x, sometimes I just lose all my money, sometimes I get my principal back. So that's what investment is all about. So while investing, one needs to really focus on what we talked about. Is 70% focus on the team and the execution capability, 30% focus on the business and its scalability, its revenue model, its go-to-market strategy, and the unfair advantage. So that's what should be the investment thesis for most of the investors to have a successful exit out of the investments. Before I sign out, I just thought I'll share a quote with everyone, which I really like. And I also see many of my portfolio companies going by this quote, and they instilling this in their lives, which says that dare to think, dare to dream, dare to fail and fall, dare to rise again and succeed. Thank you, everyone.